is the Success Happy Hour Experience, and today we're talking about a key topic, inflation. Inflation's ravishing the globe. Banks thought it was okay to print a pile of currency at the behest of finance ministers and politicians throughout the globe. While that had short-term benefits, it has long-term repercussions. And on top of it now, there is definitely corporate price gouging happening across the board. Here in Canada, we see it with big grocery store chains. Not going to mention a direct name on this show, but we do know it's happening. And one great tool to use, and I'm learning a ton about it, and we're going to talk about this today with the Wealth Without Bay Street podcast host, Rich Canfield, is insurance and how insurance can bust inflation for you. Rich, welcome to the show, brother. How are you? Great to have you back. It's always a pleasure. You are a light bulb of information on this. As we get into this, how did you get started into this road of finance and this particular style of alternative financing, of how to become your own banker, how to leverage dividend paying whole life insurance to really build a prosperous future for you? And also we'll get into why whole life insurance, dividend paying whole life insurance, is such a powerful vehicle.
Well, great question, Rob, and pleasure to be with you on the show. And the story of getting involved is, I would say, accidental. Like a lot of good things that happen in your life and tend to be accidental from time to time. So I'm actually a recovering electrician by trade. That's my background. And I grew up in a small town in Alberta, a very small town. We had a population of 300 in the community I grew up in. And we owned, my parents owned, and I, by default, had the privilege to work like a rented mule in their business. We had a business that was a septic tank cleaning and portable toilets. So we would deliver portable toilets all over Hell's Half Acre. And, a lot of good memories, a lot of work involved in all that. And so I learned a lot about things financially, when I was about 11 years old, roughly 11 or 12, my mom had a conversation with me. She said, okay, from now on, you're responsible for buying all your own stuff. Hey, we're going to feed you. We're going to take care of this. But if you want to go get Sega Genesis video games, you want to go get that, you want to go buy chips, you want to go get Slurpees at the store, etc., that's all on you. Things like buying some of my own clothes and that kind of stuff happens. So I learned to be frugal early on. And I was actually known as, quote unquote, the bank at my house. And I got fascinated. I remember when I was buying our second rental property as a family, I just turned 18. In fact, the process of buying it started before my 18th birthday. And I was looking at the mortgage documents. And at that point in time, the interest rates had just dropped. And we were getting a mortgage loan at 6.97%. And we were high-fiving one another because it was the greatest thing since sliced bread. And so we got this rental property, and I was looking at that loan document, and I went and figured out how to run an amortization because I was really curious. And when I ran and looked at my first amortization, I felt like that feeling where it's kind of like you've been hit with a 2x4, kind of like Tommy Boy. It's like it doesn't hurt so much here or here, but right here. And I was looking at how much money in the very first couple payments went to interest, and it was actually mind blowing to me. And I just started thinking about it. I said, well, this is a racket. Why are we buying this real estate? Why don't we just get into this business? Like, this is what we should be doing. If this is working so well for them, I want to be on that side of the equation. I didn't know how that was going to work. And so it wasn't long after that, I went and bought this book. It was a little black book, and it was actually a book all of numbers, and it was an amortization calculation book where you could flip through different interest rates and different amounts of money, and it would pre-calculate the payment for you. And I would flip through that book, and I was just fascinated by it. And so lo and behold, later on, I continued my journey into real estate investing, and I got involved in real estate networking groups, et cetera. I met a lot of great people. And, continuing, purchasing real estate. And then I learned that you could do private lending with registered accounts. So TFSAs, RSPs, well, TFSAs didn't exist at that point, but RSPs, et cetera. You could do a self-directed account, and you can lend them as a first, second, or third mortgage on a piece of property. There's a way to do that. Understanding that process was really eye-opening. I said, this is it. I figured it out. That thing I wanted to do, I now know how to do it. I know how to, quote unquote, become the bank. But I only had little bits of the information, if that makes sense. Shoot forward to 2009, my partner, Jason, who who's been on the show before, we were engaged in a different business endeavor. And at that point in time, I had just, became a real estate agent in Alberta. I was leaving my electrical career and transitioning to something new. And he told me to go and buy this book, Becoming Your Own Banker by R. Nelson Nash.
Yeah, and that's a great book. You sent me a copy of it, ladies and gentlemen. Get a hold of this. Get a copy. I mean, he's got his own kind of, as I mentioned, he's got his own religious views a little bit in here. You got to put that aside because it just has excellent information. There's a lot of factual information. I'd say that 90% of this book is very valuable substance, whereas most of what you read, you got to find 25 to 30% is really valuable, if that. And I'm even talking academic guides, textbooks, all of that stuff.
And this book, it's only 92 pages, and only 77 of them have words you need to read on it. So it takes the average person, somewhere between 2.5 and 3.5 hours to go through it. Or you put it on the back of the toilet tank and you kind of churn through it over 2 weeks or whatever, and you'll have that whole book consumed. And it's kind of like the gift that keeps on giving. So mine, I don't know if you'll be able to see this or not, Rob, but there's a few highlights and notes and stuff that you're flipping through.
I'm just doing the first read, so I'm not quite there yet, but I think I'm on page. You're right. I have a side job at the National Arts Center bartending, and I'm already on page 69. And I read these in 25-minute spurts on breaks between intermission, like the show, and when the bar closes and the intermission for the show reopens, you got to crack the bar open, and you've got a 4-hour window. The shift's a 4-hour shift, and it's great because you hustle for 2.5 hours, an hour and a half you sit down. So I do work and educational stuff on the side. I just keep my brain fresh that way. And it's
there you go. Yeah. And keeping your brain fresh is important. And so this book, like say any 25-minute increment, you can read a page or two, and you can walk away with something you can kind of chew on for the day. On page 85 of the book, Nelson says that if you knew at passive income time, you would be getting back every single dollar that you put into a system, potentially tax-free. Would you ever object to putting any more money into it? It's obviously a rhetorical question. No one's going to say, oh no, of course I wouldn't.
Well, why wouldn't I? Exactly. I wouldn't do that.
But reading that book in 2009 completely changed my life. And I got really irritated and angry with people. I had a chip on my shoulder for a while, and I couldn't figure out why. It was because I knew that this was what I'd been looking for in my life. And the problem I had was that you may not know this about me, Rob. I'm not a big fan of big government, et cetera. And so I knew,
can't stand
I knew in order to teach this concept, it's kind of like you like a great wine, you like a great beer, a stout or something. You're going to make a recommendation. That's who you are. That's part of your jam, So you don't hide that information and just keep it all in Rob's noggin. Like you're going to let that out so the world knows that this is pretty fantastic. You should go and get a bottle. Well, I felt the same way about this information. The problem was, in order to do this effectively, I needed to go get an insurance license, and I didn't really want to do that at the time. So I struggled with that for a couple of months, and then I made a decision. You know what? This was put here in front of me for a reason, and I'm not going to be an integrity in my life if I don't go and do this. I'll feel out of place in the world if I don't go and share this information. So that's kind of how my start came about, and then that led us down a path of research and figuring out how does this work in Canada? How can we do it in Canada? Can we do it in Canada? And digging deep into that information. And then we really got started. And I delivered the first presentation that I'm aware of, at least anyway, about this concept in Edmonton to a group of about 6 people in early January 2010. And then following up, a year later, we were launching a course that we were delivering to people. And then we delivered that course, eventually, we were doing it almost 3 to 4 times a month to groups of 30 to 40 people. Last week we just did a webinar with our company, Ascendant Financial, where we had 250 people on. Literally last week learning about this, and so we're helping Canadians coast to coast, and we have a ton of fun doing it. And shoot forward a couple of years later, I actually went down to an annual conference we do, which is every February in Birmingham, Alabama, where Nelson's from. And call our annual think tank conference. So I'm excited to go do that trip. I'll be speaking with Jason at that event here coming up.
That's awesome.
But in 2012 was my first session there. And so 10 years ago is when I first got a chance to meet Nelson. And Nelson really poured into me as a mentor and as a friend and as an amazing individual, as an inspiration. And he really changed my life. There's not a single aspect of my life that isn't positively impacted by knowing that man and knowing this information. So it really has infused in all areas, much beyond just the financial category. But circling to kind of the inflation aspect is, it's a big hot topic right now, but the reality is it's always been a hot topic. It just wasn't marketable until it became a problem for Canadians.
Well, no, because it just floated. It floated at that, it was almost a negligible, invisible level, I would say. It's like, 0 to 2%. So it's always there chewing away at your wallet. It's like the time value of money. I learned this in financial accounting in first year university. $1 today is worth 71 cents in 5 years. And that was based on actually more or less the inflation rates we're facing now, because that was in the early 90s, coming out of the 80s. As you mentioned, people high-fived at a 6.9% mortgage rate. I mean, it got up to 22. And cheers to that, and a happy hour. By the way, I'm going to be brief on this. I know you're not drinking. It's 8:37 in the morning where you're at. It's 11:37 here. So I'm drinking a Frizzante from Nova Scotia. This is Nova 7 by Benjamin Bridge. This is brilliant. It's a low alcohol wine, 6.5%. It's got a lot of residual sugar. There's a lot of ripe apple and citrus notes. I'm actually presenting this to the Bank of Canada officials at a tasting. Honored to be there. And, believe it or not, they're very well aware of the restrictions on policy too. I mean, that's sort of in a discussion over here as well. It's pressure by our federal government, which has actually led them to probably pursue a policy that they didn't fully want to pursue in the first place. But, intertwined with politics
I can see
and
that
policy.
being the case.
And that is the case. I mean, most bankers want to have stable currencies and stable economies because especially publicly owned infrastructure. And we're not going to talk about private bankers. That's for profit. But when you're the central bank and not the Federal Reserve, because unlike the Federal Reserve, which is a privately owned corporation that pays 6 families massive dividends annually, that's right in their front page, you have... I apologize for that ping coming up. I think I had a chat open and it hasn't closed on this program. But central banks, their interest is, especially the publicly owned like the Bank of Canada, it's a crown corporation, is to stabilize the economy. It's whether they're effective or not at it. And right now, we do have inflation, and how... enjoying this, of course, over that discussion. It's like a mimosa or a light champagne, great drink to have in the morning. How do you use whole life to get around it? I mean, this is a fascinating topic because this book highlighted the fact that income tax is from 1913 forward approximately, or 1914, and actually even older than that. It's even younger than that. It's a War Measures Act to raise money in order to pay for war temporarily that was supposed to be removed at the end of the war. That didn't happen. But this is much older. This is a much older system like gold and silver investing.
Well, it's one of the original. I mean, today people don't realize because we live in a very different financial world. That whole world shifted starting after World War II dramatically. And because of the baby boom, as the baby boom shifted, a lot of things happening in our world. And then a lot of things that happened in the 70s and early 80s shifted things that happened in the insurance realm, et cetera. So people don't understand that fundamentally, if you go back to World War I, the Great Depression, and then beyond that earlier, participating whole life insurance was a fundamental component of the savings vehicles available to the general public. It was one of the staples that was in everyone's household, not only to protect their family, but also because it was an asset. And, it's kind of like you would get bearer bonds and things that you could go and trade in for capital. Well, you could do similar aspects with whole life insurance. So that's never really changed.
That makes sense.
And it's been engineered. It's an engineered outcome because it's actuarial. Actuarial science is basically the engineering of financial tools like pension accounts and pension funds and insurance, et cetera.
Sure.
And so when you break it down, it's actually pretty fascinating. I won't bore everybody with all that stuff. But
no,
the end result
it is. Can I share a story with you on actuaries quickly here?
Of course.
So I was working for a company called Midland Wallen. I was a call boy, basically doing cold calling for 3 stockbrokers when I was 23 or 24 years old. I only was there for a few months, hated it, did really well. They didn't want to pay me well. That's partly why I just decided to not really turn up anymore for them. And that happens when you underpay, and that's an endemic problem today. But, I sat on the bus and I got into this conversation with this really nerdy looking guy, and he was visibly older. He was probably in his late 30s. Wasn't an old guy, but at the same time, he was an actuary. So we started talking about actuarial science, and he actually asked me how long my grandparents were alive for. And at the time, only one had passed, and he passed at 80, but the rest of them were alive and into their 80s, and a great-grandmother at 106. And it's interesting that they mentioned this. And he looked at me and he said, well, because he's an actuary, the death table would actually favor me for long longevity. He said, your longevity is not actually based on your parents because it's too short of a timeline. It's based on your grandparents. It skips a generation to measure how long you're actually probably going to live within plus to minus. He said plus to minus 7 years based on how you live. You live extremely fit and healthy, you're going to gain 7 over the norm. If you live unhealthy, you're going to lose 7. And it was like he said, we can measure this to a T.
Well, that's the key, is they can measure it. And so actuaries know that everyone's got a limited time on planet Earth. They know they look at a pool of 10 million selected lives. Selected meaning they've gone through a screening process. Okay, you're
of
this
every
tall,
type of life.
You're this wide. You smoke, you don't smoke, etc. So you fit into that selected life section. There's geographical factors that they assess as well, and then they look at, okay, well, we know over this period of time to age 100 exactly how many people are going to die each year. We don't know which ones, but we know exactly how many. Because we know how many, we can calculate very accurately what we need to take in as in the form of a premium to make sure that whole system operates so that everyone's protected. Well, they don't have every single year down pat. So what they do is they pad up and they take more than is necessary, and that extra capital goes into a giant pool, and that pool gets put to work for the benefit of everyone that's in that pool. And this is how par whole life insurance works. So that pool has been put to work for well over 100 years. And in fact, one of those pools has been paying dividends to participating owners since 1848 in Canada, which is before the signing of the British North America Act. So we're not talking about something that just started yesterday. We work with one company primarily. They've been doing this every single year, profitably paying dividends to participating owners as a share of profits every single year since 1936. They started in the Great Depression. They took one of the worst financial economic times in the world, and that's when they started doing this because that's what people wanted.
Yeah, and so that's crazy. That's so long. It's such a history.
It's such a tremendous history, and they just announced, an epic increase in how much they're going to pay out in this coming year because they're doing exceptionally well as a company. And so, I personally and my family, we co-own part of that insurance pool. In fact, I have policies with multiple companies, and so we co-own that pool with other free people in free contract with one another. No one puts a gun to your head and forces you to go get an insurance contract. Okay, you have to voluntarily decide to do it, which means it's free contract. So you make the choice to be involved. And when you're a participating owner, you co-own that money pool. One of the good things is when you can access from that money pool as a contributor, as an owner, you have contractual ability to do that. Well, when you take money out of that pool, you're borrowing from the insurance company itself. Well, if I borrow from the insurance company and they charge a little bit of interest, doesn't that money go back into the pool that I co-own? Which means I get to share in those profits with everybody else. Here's the beautiful thing. It's an on-demand loan, which means they have to give it to me. They can't say no. It's a contractual requirement for them to provide it. And there's no payment adjustments. It's unstructured, meaning it doesn't have a monthly payment or you got to pay it over 5 years or 25 years. You have complete and total control over the use, liquidity, and then the return of that capital. And if you put the money back in, well, it's just like if you took money out of your savings account, you went and spent it, and then you put the money back in your savings account, you can spend it again. You can go do something else.
You regenerate it and you reinvest it in a sense. Yes, absolutely.
Right. The only difference is, other than your savings account, is that you're also covered by a massive tax-free benefit that's growing every single year. And the cash value asset is constantly increasing each and every day that you take air into your lungs, because it has a contractual feature that says by age 100, the cash value, which is your asset, must grow to equal the total death benefit. And in fact, we wrote a book on that we just released over Christmas called Cash Follows the Leader. Uninterrupted daily growth with high cash value insurance. And we explain exactly how that happens and why it happens. So what we're talking about, the idea of becoming your own banker and solving some inflation issue, which we'll touch on, is around having control. So, in real estate, it's location, location, location. In becoming your own banker, it's control, 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 right? These are the magic words. So you want to always try to have the most amount of control over your financial circumstances for the longest period of time with the least amount of hassles. That's what this process allows you to do. The insurance is simply the tool or the vehicle that allows that process to take place. Okay, so the process of being your own banker is a mindset. It's how you think about moving money in your life. It's the transactional nature of how you deal with in and outs flow of money in your life. But the tool, the whole life insurance, is just the engine that helps run it. You're driving the car, but that car's not going anywhere if it doesn't have an engine. Well, the whole life insurance is the engine of that vehicle. But you get to choose where you turn, how much you put on the gas, if you want to put anything on the brake. But there is no reverse gear. Once you get it going, it does not stop, and it doesn't slow down. It actually speeds up,
which is fantastic. It's something that I was taught, and I wish I knew this because I'm 51. Yes, I'm in great health, no medicines. There's a lot of positives. But obviously the fees are going to be higher, but we can get started at any time, which is magical in itself. But I sort of fell into the loop. I was almost involved with this company called Primerica, and they talk about dividend, they talk about term and buy the difference. And then everyone started preaching, buy term and invest the difference. The Wealthy Barber by David Chilton said exactly that. But in a sense, that's deceiving and deception, isn't it? It's actually wrong.
Yeah. So, I mean, here's the issue with it. Fundamentally, it doesn't have anything really wrong with it. And for the odd person, it works out. The problem is most people buy term and then they spend the difference. So that messes things up pretty quickly.
Correct.
And then the other piece of the problem is that you're going to invest the difference, which means every dollar is being placed into something that is now at risk. And this last year, people have lost 30 to 40% of their money. Oh yeah, they were way up, but now they're way down. And so how long will it take them to recover? So this isn't talked about very well in that. They just say, oh, over time, it just goes up 10% like clockwork. Well, what if that down market doesn't coincide with your retirement date? Now you're working an extra 10 years. Sorry. I know people that have experienced that in 2008, personal friends, colleagues, and family members that have had that happen to them.
Yes.
And so it's not that that's wrong. It's that it's misleading and it doesn't tell the full story. So here's the thing. If you can put money away into a pool that you co-own and you can access capital on demand with no restrictions, can you not still go and invest money and do some stuff?
Of course.
And still have the insurance and do the best of both worlds? See, this is it's an and asset, not an or asset. If you have your money tied into whatever ABC fund, RSP, etc., it can only do the job of that one thing. It can't, as soon as you want to go and move it, do something else, it has to come out, or you got to sell that investment and you got to move it to a new one. It can't do both. Well, with the power of collateralization, you can do both. And you can have capital working for you in two places at once, really three if you factor in the value of the death benefit. And here's the key thing. I don't know anybody, and I've been doing this for a while, I've never met a single person that said, boy, I really hope that no tax-free money shows up when I die to solve all the financial problems I leave behind for my family. I've never had anyone tell me that.
No, and that's what I'm getting at. That's, so two things I want to ask for the viewers. What happens, you see those money charts, right? With mutual funds, age 25, kid starts out, age 65, worth $20 million and all this fallacy and bullshit because it
Nelson
doesn't
Nash
take
calls
into account.
The mountain wave graph of lies.
It is, because really life is like going up a staircase of a broken yo-yo. Even when you win, it goes from here to here. You deal with death, you deal with loss, you deal with divorces, you deal with job changes, you deal with a business going defunct. These are all real pitfalls of life. In fact, these are really parts of the money trap that are real. And, RSPs, for instance, you're locked into a government-controlled system. You have no say. It's bullshit. It's a tax write-off, in my view, with maybe a bit of a benefit. But the benefit's not great because they destroy you with taxes on the way out when you cash out and you're retired. It's a terrible way to go. You're better off in gold, silver, and cryptocurrencies and walking across a border with all that wealth to wherever you want to work or live because they can't touch it. The other part of it is they don't have control over it. They can manipulate the value of things like gold and silver, but they cannot destroy it completely. And they can't control what you do with it if it's in physical form, right? In minted coin bullion form that has a currency stamp on it, that 1 ounce gold coin worth $2,500 crosses a border of $50 because that's its currency value. And all these things are rigged to play for the rich, but people have to understand them. The other thing is, can you cash this out once you become an expat and say, screw it, Canada's turned into a second-rate country, because right now it feels like it's turning that way. and go live somewhere else. I mean, people are waiting in Ottawa. We have 150,000 people without a family doctor. Think about that. In this country, roads aren't getting paved properly anymore. Debt is skyrocketing. The only solution that politicians have when the crunch time, the gun hits their head, is to raise taxes. So hopefully pay off or bribe us with another program to buy our vote. So,
well, and on that note, here's a couple
can you
fundamental questions.
Take this? Yeah, sure. Go ahead.
If so, further to that, it's okay. In your lifetime, just think about this as a listener. In your lifetime, what direction have taxes gone? Up or down? Then think about your parents and your grandparents' lifetime.
Taxes generally have been a yo-yo, right? So in my lifetime, they've been high, they've been lower. They've gone up, they've gone down.
Well, our brain is thinking about income taxes. Think about taxes on all things across the board. Now,
you're right. It's gone up.
Then look at this. Okay. With all the spending that's happened, especially given COVID and some other, things that have transpired, what is the probability, low, medium, or high, that taxes are going to go up in the future?
High.
And if you say it's high, what's the primary revenue source for the government?
Income.
It's the people.
Labor.
It's income and it's the people,
labor.
Which means
not capital, but labor.
The only way that tax burden can be funded is from the labor force. So if you're the labor force, or you've been pushing aside your labor force income into a tool that is where you're saying, I don't want to pay the tax today. I'm going to put my seed in and I'm going to pay tax on the harvest. Well, do you want to pay tax on the harvest or the seed? And now you're putting yourself in a position where you've been told that you're going to be in a lower tax bracket. Well, in order to be in a lower tax bracket, you got to choose to live in poverty. If you want to be in a higher tax bracket and have more income at retirement, well, that means you're going to get taxed on more of your income. And at a tax rate that you don't know. You and I don't control the tax rate. So we need to have areas where we can create more control. Nelson says this in his book, that when dealing with government, it's a parasite-host relationship. Government is not capable of producing anything.
Nothing.
It gets all of its sustenance from the productive element of society. Government is a parasite that lives off the productive taxpayers, the host. It is self-evident that if the parasite takes all the produce of the host, then both parties die. So when he talks about when taxation becomes onerous to the point where government officials sense rebellion, they always resort to an exception to the rule. They invented qualified pension plans and tax plans like the RRSP. What a classic case of appointing the fox to guard the chicken house. How absurd. So in other words, they know about it. It's all tracked. They know how much you can put in. They know how much you got in there. They are banking on the baby boom generation, et cetera, and the secondary generations coming up. They need that tax revenue to support all of the social programs that we have to pay for. They're expecting it. They want that to be a big account because they need the revenue coming in. Do you realize that when people graduate, when they pass away, the tax bill that is paid is so enormous for the average person that it would boggle your mind? And yes, you might be able to roll over an RSP account to another person. There's some rollover, but all you're doing is you're just passing the buck forward one step further. For a lot of people, and I have clients that have experienced this when parents have passed away, et cetera, they spent their whole life doing what they were told to do, putting their money into these registered plans and blah, blah, blah. And it was going to be okay. And the government's looking after me and everything's going to be fine. They took it on the chin in every market along the way. They dealt with all the stress and the sleepless nights. And then when they kicked the bucket unexpectedly, 50% of everything that they thought was theirs goes to the CRA, which means they took all the risk. They paid all the fees. They had all the sleepless nights to manage 50% of money that wasn't theirs. You're a custodian for 50% of the government's money. Well, if you want to go back to buy term and invest the difference, what you're doing is you're choosing to eventually give up tax-free money because your term insurance is going to disappear. You won't be able to fund it anymore. Hopefully you're still healthy when it goes. We'll see. And then put all the money into taxable accounts and then pay a massive tax bill the day so you're supposed to be self-insured, except 50% of the money isn't yours. So how much is left for your family? I can tell you from families that have experienced it, and I have these conversations on a regular basis, very little. And they're astonished, pissed off, and they wish that someone would have told their parents something differently. Now, don't let that be you.
Well, it hasn't been me in a while. I mean, I started to follow Mike Maloney's Hidden Secrets of Money. I got into gold and silver investing. It's owning a bit of bullion physically and having it locked and vaulted away makes you feel damn good because it's an asset you own. You actually own something. The paper in your pocket is worthless. I think I did that illustration on your show where I held out a $50 bill and I held out a silver coin.
The silver bullet,
and I said, which person, the silver bullet, what would the average person pull who's ignorant? I could tell you around the world, they wouldn't be reaching for the bills at all, would they? No way. So it tells you what real wealth is right there on the spot. It's not this currency that's backed by nothing. It's things that are of real value. And it's neat because whole life just gets right around the whole taxation plan because insurance companies have been around a lot longer. And they lobby government. They all lobby the politicians to get what they want because they keep in mind, these companies that you have your policies with are mega billion-dollar powerhouses that are not to be messed with.
And they've been doing it for a long time. And
power.
It's slow and boring, but it works. It's kind of like you see that movie Moneyball, where they won the championship or whatever because all they did was they just focused on getting on base. Oh, why does it work? He gets on base. He gets on base. He gets on base. Well, that's all the insurance companies do in the whole life. They just boom. They're just hitting grounders and they're just getting on base and they're just knocking runs out every single year like clockwork. And what's really so going back to the inflation thing, I want to touch on this, Rob, real quickly, is that a dollar. So when is a dollar worth more, today or tomorrow? Well, you already said it. It's worth more today because tomorrow that dollar will be eroded. Well, if you put a dollar in today into whole life insurance premium, which you decide, you control, you work with a coach to build all those dynamics, you put a dollar in. Well, next year that dollar got worth less, but the policy grew. So you're now paying the premium with cheaper dollars. Does that make sense? You locked in the strongest dollar when you set the contract up.
Yep.
You follow me?
Yep.
And so Nelson Nash experienced this in his own life. One of his first policies was in 1959. It was $388 a year. It was a $20,000 death benefit. That was a big money back in that time.
Huge.
Well, when he passed away in 2019, that policy paid out a death benefit of about $150,000, and it was more than 5 times what he started with. Does that make sense?
Yes.
His premium was the same the whole time. He was using $1959, getting $2019 out. You follow me?
I do.
Now, what you can't see is, first of all, the first 15 years, he stunted the growth of that policy because of what other people told him, and he didn't know enough. That was a learning lesson. Second thing is that he made 3 real estate investments out of that one policy. And those investments alone, because he had readily available access to capital on demand at his terms, dwarfed anything that the policy did in an epic fashion. Now, when he passed away in 2019, I miss him dearly, rest his soul. 88 revolutions around the sun is what he would say. Nelson had 17 death benefit checks pay out when he died.
Wow.
But there is 28 whole life contract assets. It's like, imagine there was 28 houses you own in your portfolio that you still had. They're still around, and his family's using them.
Wow.
So 17 death benefit checks paid out, plus 28 assets still in force, which means there's 28 more that are still going to pay out that he started in his lifetime. He got to use them, and he got to pass them on. And he didn't have to ask anyone's permission, including the government. And the IRS didn't get any piece of it. Well, that's power, and that's control.
That is power. We're going to wrap things up here. I want to just feature this. Ladies and gentlemen, make sure to subscribe to this as well. This is a great channel, Wealth Without Bay Street Infinite Banking Podcast with Jay and Rich. This is a tremendous show. I've been a guest on it. Make sure to check this out. Make sure to subscribe. Make sure to smash the likes on their show. Do the same for mine. But we're focusing on them today, and this is what you need to look at. And, getting back to it, we're going to close up. We went way longer than I expected, but that's completely okay. The thing about investing is you need to put a plan together for you. Rich is a financial expert, and he's a licensed expert, so we can have this discussion. I am not, so make sure to consult the licensed experts. When I talk about gold and silver, go talk to somebody who really is licensed, because they can probably give a summation of what I gave you because I've consulted the experts, or cryptocurrencies. I consult experts on these things. But these are growing pools of money that are going to do tremendously well. And I don't think you're in denial there either, Rich, because they're out of the banking, private sector banks' control. They really are. They're global entities. That's dangerous. They can control exchanges. They can't control wallets. It's like a Swiss bank account. It's vaulted. And you watch, laws will come, new wallets will be monitored, but the old ones won't be, because that'll be the deal that's struck. It's like having an insurance policy from the 18th century to now. There's definitely different terms and conditions in it.
Yeah, but, grandfathered.
Talking about taxes going up, we do have a little bit of hope. There's Republicans in the House, and this is where it's starting now because they won control of the House, that are now talking about abolishing income tax. And you know why? Consumption taxes work way better. When you go to a tax haven like Grand Cayman, or Grand Cayman, where my old accountant now lives and works, you pay consumption tax. Now, consumption taxes can easily eat up 25, 28% of your income. But if you're a regular consumer and you're middle class, probably more like 18%. Cost of living's higher, but you get to keep 60 some odd percent of your salary in your pocket after paying for everything. That's way ahead of the average Canadian that can barely even save 3% of it. And then on top of it, consumption taxes nail the rich the way they should be. Because the rich will pay themselves in loans and through insurance policies and through dividend paying checks off of their companies and hedge all their money in their corporations and skirt taxes. In a high tax place, they're really still paying very low taxes. And there's not a thing that the country can do about it. Politicians aren't going to change it because, listen, politicians are funded by these people. It would be the death knell of their career if they tried to go after them.
Well, and if the businesses leave because of the climate,
right?
If the business leaves because of the climate, then they take there's no more jobs, which means there's no more guaranteed income for the government because it comes right off the employees' checks.
Right. And if anything that's going to change our government coming up, it's the total mismanagement of the economy. I mean, here in Ottawa, our mayor has left this a mess. We have an LRT situation with, light rail doesn't even work and it costs billions. You get people, and I heard this yesterday, people who have contracts with the city hasn't paid them in a year. Well, it's going to happen to the city. These people are going to take them to court and clean them up in court. Really, what should happen is half the city should be fired over stuff like this, and they should actually start controlling how they spend money. And that pools of money should be allocated for what those taxes are set aside for. I do believe in civil society. We have to pay some taxes. You do need roads. You need hospitals. You need educational centers for people. You need a military to protect you. You need a police force. You need a firefighting force. But, I mean, we have layers and layers of it. Like, for instance, the CPP gets raided. I think Jean Chrétien did this, and so did Harper. When they raided EI or CPP, I can't remember which was what, to pay down debts and to get us into a surplus. That's what Harper did. That's what Jean Chrétien did. It worked, but you're stealing you're stealing the future to pay for now.
Well, and that's one of many reasons that the CPP payroll tax went up this year. I mean, it has to go up because of an actuarial issue. But but it went up in a double-edged sword. We actually did a video on our podcast about this, and you can feel free to go and check it out. But I had a CPA friend of mine on to talk about it because it's a double whammy, and these are they happen because they happen on their paycheck over time, and you don't look at the number, you don't reference what it was the previous year. You don't really see it happen. It's happening, but it's happening almost like it's kind of like we call it the boiled frog theory.
Yes, I know
the
that
idea
theory.
that you can, you put a frog in water and you just slowly turn the heat up and eventually
you kill it.
It's I don't believe it's actually true, but the concept of it is what we're getting at. And I think overall, as Canadians, we've been sitting in lukewarm water that's been turned up slowly over the last 50 years, and the heat's rising, and we just don't know what's going on. And it's important to start taking active control and management over your financial life and your affairs, and don't take for heed every single thing that you see on the 6 o'clock news, because not all of that is necessarily there. It's there for clickbait. It's not there to get you to think. And so one of the primary things that I learned from Nelson is that you got to rethink your thinking. And just when you think you know something, well, now if you get locked in on that, then that means you may have lost the inspiration to learn something new. And you get what's known as the arrival syndrome. Hey, there's no point in teaching me anything new. I already know everything. Well, if you know someone like that, don't be that guy. Don't be that gal.
We know people like that. Well, listen, you've been a terrific guest. I'm going to have notes as to where to reach you. People, ladies and gentlemen, you need to reach out with him. Set your policies up with him. This is going above and beyond your standard insurance agent. This takes it to the level it's supposed to be taken at. Somebody who really understands it, who's not just peddling a product, because people see insurance people and flee for their lives like we look at lawyers and politicians. And the problem with that is because of what you see on the 6 o'clock news. Ladies and gentlemen, I hope you've loved this show. Rich, you've been a terrific guest. Cheers, my friend. Much love. Ladies and gentlemen, whatever you decide to do, have a terrific day. This is Rob and Rich from the Trucking